Welcome to Reporting Matters, where we explore the world of corporate accounting. This episode is presented by artificial intelligence hosts and is for educational purposes only. For our full disclaimer, stay tuned until the end of the show. Let's dive in.
This is Reporting Matters. The Corporate Accounting Podcast starts now.
You know, when you picture an auditor at work, you probably imagine, well, someone sitting in a brightly lit cubicle, right? Like just staring at a glowing spreadsheet, clicking through cells.
Oh, yeah, absolutely. It feels very binary to most people. Like the numbers balance or they just don't.
Right. It seems so sterile.
Yeah.
But if you actually talk to a seasoned auditor, they will tell you the real work. I mean, the gritty, high-stakes stuff. That happens at like 5 in the morning, usually in a freezing cold warehouse.
Oh, the physical inventory count.
Yeah.
Wearing a high-vis vest, holding a clipboard, freezing your hands off.
Exactly.
You're standing there looking at, mountains of cardboard boxes stretching all the way up to the ceiling. And you can count every single box perfectly. You can verify that the physical stuff actually exists.
But here is the terrifying realization, especially for anyone relying on those financial statements. Whether that multi-million-dollar number on the balance sheet is actually real, well, that entirely depends on the math happening in the background.
Right, the valuation.
Yeah, if the rules of that math are rigged, that whole physical warehouse is basically just a financial illusion. And today, on this deep dive, we are going to dismantle that illusion. We are opening up IAS to inventories.
Which I should say is not just some dry set of accounting rules.
No, not at all. It is the ultimate field manual for catching corporate financial manipulation right where it most frequently happens.
It really is. It serves as this fascinating psychological profile of corporate temptation. But before we could appreciate the fortress that IAS 2 builds around a company's assets, we kind of have to look at the battlefield it was designed for.
Right, the before times.
Yeah, we have to go back to the era before this standard locked things down, a time when inventory was essentially, a playground for earnings management.
It really was the Wild West, because before this standardization, the whole system felt like, like a choose-your-own-adventure book for corporate profits.
That's a great way to put it.
It makes me think of like a shady retail store owner who prints 2 different price tags for every single item in their shop. When the tax authority walks in, they slap on the low price tag to show they barely made any money.
Right, to dodge the taxes.
Exactly. But then when the bank manager walks in to negotiate a loan, they frantically swap to the high price tag so they look incredibly wealthy and asset rich.
That captures the dynamic perfectly. I mean, companies had this incredible, frankly dangerous flexibility to just switch between different valuation methods year over year.
Depending entirely on what narrative they wanted to spin for Wall Street,
Yeah.
right? Or their lenders.
Exactly. If they were having a catastrophic year and needed to, say, artificially smooth or inflate their profits, they didn't even need to sell more products.
Wow.
They just tweaked how they valued the boxes already sitting in that warehouse.
Okay, so mechanically, how does that crime actually happen? I mean, if you are an accounting student listening to this, trying to think like a lead auditor, you need to know the weapon being used.
Right. You need to understand the mechanics.
I assume it all comes back to the relationship between the balance sheet and the income statement, right?
It does. The mechanism relies on one very simple but incredibly sensitive mathematical equation, and that is cost of goods sold, or COGS.
Okay, let's break that down.
So your COGS equals your opening inventory, plus your purchases made during the year, minus your ending inventory.
Wait, let me just map that out mentally. So opening inventory plus purchases, that is the total amount of stuff I could have possibly sold this year.
Correct. The total goods available for sale.
Right. And then I subtract the ending inventory, which is the stuff still sitting in the warehouse on December 31st. So whatever is left over, well, that must be the cost of the stuff I actually sold.
Exactly. And that cost of goods sold goes straight onto the income statement as a massive expense, which drags down your profit.
Okay, I see the vulnerability here. Look at what happens to that equation if management finds a way to artificially inflate the value of that ending inventory.
Right. If they make those boxes look more valuable on paper than they actually are.
Yeah, because if they do that, they end up subtracting a much larger number in the COGS equation. It's like a seesaw effect.
Oh, absolutely. A direct seesaw.
If the ending inventory number goes up, the mathematical result, the cost of goods sold expense, has to drop. And if your expenses drop, your gross profit artificially skyrockets.
You nailed it. By stuffing fake value into the balance sheet, they are literally stealing expenses out of the current year's income statement just to make themselves look highly profitable today.
That is wild. It's a zero-sum game between the two statements.
It is. And that specific financial reporting risk is exactly what IAS 2 was written to stop. The standard has one explicit objective, which is to prescribe the accounting treatment for inventories. Specifically, determining the strict amount of cost to be recognized as an asset and carried forward.
Carried forward until the related revenues are recognized. It basically builds a massive wall around that ending inventory number.
Right. And at the foundation of that wall is something called the prudence concept.
The prudence concept, it sounds like something out of like a Victorian novel.
It does, yeah. But it's actually a pretty brutal reality check in practice.
How so?
Well, the prudence concept dictates that inventory must be measured at the lower of cost and net realizable value, which we usually just call NRV.
The lower of cost and NRV. So that means an entity can never carry an asset on its balance sheet at an amount greater than what it reasonably expects to recover when it finally sells it.
Exactly. Let's say a company spent $10 manufacturing a specialized widget, but consumer trends shift overnight, and now they can only sell it for $8.
The balance sheet has to say 8.
It has to say 8. The pain of the prudence concept is that it forces you to recognize bad news immediately.
You take the loss the moment you know about it.
Right. You cannot hide behind the historical cost of the asset if the future reality is bleak. But conversely, if the value of that widget jumps to $15, you don't get to recognize that good news yet.
Oh, I see. You don't get to claim that extra value until you actually make the sale. Bad news is immediate. Good news has to wait.
That is prudence in a nutshell.
Okay, so before our lead auditor can even start checking the math on these widgets and enforcing this prudence concept, they need to know exactly what they're looking at.
Setting the boundaries.
Yeah, like if I'm walking through a corporate facility, what even counts as inventory under IAS 2?
We have to open up the glossary here. The standard categorizes inventory into 3 distinct buckets, basically based on their stage in the production cycle.
Okay, what's bucket 1?
The first bucket is raw materials and consumables. These are the foundational supplies just waiting to be consumed in the production process.
So if we use a large-scale commercial bakery as our mental model, this is the flour, the sugar, the yeast just sitting in the storage silos.
Got it. The uncombined ingredients. Bucket 2. The second bucket is work in progress, or WIP. These are items caught right in the middle of the production cycle.
So the ingredients have been mixed, some labor has been applied, but they aren't ready for a customer yet.
Exactly. In our bakery, this is the raw dough currently moving down the conveyor belt or maybe rising in the industrial ovens.
Makes sense. And bucket 3?
Finished goods or merchandise. These are the assets held for sale in the ordinary course of business.
So the fully baked, packaged loaves of bread sitting on the loading dock, ready for the grocery store delivery trucks.
That's the one. That covers the standard manufacturing cycle.
Yeah.
But, a massive part of an auditor's job is actually knowing what to ignore.
Right, the scope exclusions, where IAS 2 explicitly says, hey, this is not our jurisdiction.
Let's run through those. I imagine financial instruments are out. Like, if a bank is holding a portfolio of complex derivatives or corporate bonds, they might intend to quote-unquote sell them in the ordinary course of business. But a stock certificate isn't a loaf of bread. They are completely excluded. Financial instruments are governed by their own highly complex standards, specifically IFRS 9 and IAS 32.
Because they deal with fair value modeling and market risks that just don't apply to physical inventory.
Exactly. Those are entirely alien concepts to a box of widgets.
What about living things? Say I'm auditing a massive agricultural conglomerate. They have thousands of cattle or fields of unharvested crops. Is a living cow considered inventory?
No, biological assets are excluded from IAS 2. They fall under a different standard, IAS 41.
Why is that?
Well, think about it. A living, breathing dairy cow is naturally growing, procreating, and changing in value based on biological transformation.
Right. It gets fatter. It has calves. You can't just use historical costs for that.
Exactly. And the same goes for unharvested wheat still rooted in the ground. It's excluded.
But hold on. Let's think about the transition here. Once that agricultural conglomerate actually milks the cow or runs the combine harvester through the wheat field, does the asset suddenly jump from IAS 41 over into IAS 2?
Yes. That is the exact friction point auditors look for. At the precise point of harvest, the asset crosses the boundary.
So the moment the milking machine detaches, that vat of raw milk becomes traditional IAS 2 inventory.
Bingo. The moment the weed is severed from the ground, it enters the scope of IAS 2. The living organism has its own rules, but the harvested commodity is really just another raw material.
Okay, now what about industries where finding the true historical cost is almost impossible, but the selling price is public knowledge?
Like a gold mining company.
Yeah, they spend millions digging a giant hole in the ground, but how on earth do they allocate that cost to a single specific ounce of gold?
IAS 2 actually anticipates that exact problem. There are certain assets that are technically within the scope of the standard for disclosure purposes, but they get a free pass on that strict lower of cost and NRV measurement rule.
Oh, really? Who gets a free pass?
Producers of agricultural, forest, and mineral products are the primary exception here.
Okay, so back to our gold miner. Gold has a highly liquid, universally known global market price. They don't have to pretend they don't know exactly what that ounce of gold is worth today.
Right. If they have an established industry practice of measuring their inventory at net realizable value, they can simply mark their inventory to that market value.
And what happens to the fluctuations in that value?
Any changes in the value, whether up or down, go straight to the profit or loss statement immediately.
Got it.
And the same exception actually applies to commodity broker traders.
You mean broker traders who are just buying and selling grain or oil contracts rapidly just to generate a profit from short-term price fluctuations?
Yeah, exactly. Their entire business model is based on trading the market price, not manufacturing a product over a long period of time.
So it wouldn't make sense to lock them into historical cost.
Right. So they measure their inventories at fair value. Less cost to sell. It reflects the economic reality of their specific business model far better than historical cost ever would.
Okay, so we know what inventory is and what it isn't. But here is a massive logistical nightmare for an auditor. How do I know when to start counting it?
The cutoff problem.
Yes. Let's say I'm standing on a client's loading dock. It's 11:59 p.m. on December 31st. I'm doing the year-end count. I watch a forklift put a pallet of expensive electronics onto a third-party delivery truck, and that truck just drives away into the night.
I can picture it.
Whose inventory is that? The seller who just waved goodbye to it on the dock, or the buyer who is halfway across the country waiting for it to arrive?
That is the multi-million-dollar recognition question, and getting it wrong completely skews both companies' balance sheets.
So how does IAS 2 solve it?
To answer it, IAS 2 actually borrows a core concept from IFRS 15, which is the revenue standard. It relies entirely on the transfer of control.
Transfer of control, meaning who currently holds the legal right, the risks, and the rewards of those goods.
Exactly. So it's not just about physical location in the warehouse. We have to look at the legal shipping terms buried in the contract.
We have to interrogate the FOB terms free on board.
Yes. The two most common are FOB shipping point and FOB destination, and they dictate exactly when control transfers.
Okay, break those down for me.
If the contract stipulates FOB shipping point, control transfers to the buyer the moment those goods are loaded onto the truck at the seller's dock.
Let me map out the audit implications of that. If I'm auditing the buyer and those electronics are currently in the back of a truck somewhere on an interstate highway on New Year's Eve, I have to include them in my client's ending inventory count.
You absolutely must include them.
Even though my client hasn't physically seen them yet.
Even though they haven't seen them, the buyer recognizes the inventory asset and the corresponding account payable liability immediately.
Wow.
Think about the risk transfer here. If that truck hits a patch of ice and rolls over on the highway, destroying all the goods, it is the buyer's problem.
Oh, man. So they still owe the seller the money, and they just have to hope their own transit insurance covers the loss.
Exactly. Now, what if the terms are FOB destination?
I assume it's the exact opposite dynamic.
It is. Under FOB destination, control doesn't transfer until the goods physically arrive and are accepted at the buyer's receiving dock.
So while that truck is driving across the country on New Year's Eve, those electronics still belong on the seller's balance sheet.
Correct. The seller keeps the inventory and hasn't recognized the revenue yet.
What happens if there's a dispute, though? Say it's FOB shipping point, so the buyer already put it on their balance sheet on the 31st. But when the truck arrives on January 2nd, the buyer inspects the electronics, realizes they're completely defective, and rejects the shipment. Who holds the inventory then?
That is a brilliant edge case. When the buyer formally rejects the goods due to a breach of contract-like, because the goods don't meet the agreed specifications, control effectively reverts back to the seller.
Oh, interesting.
So the buyer would reverse the inventory and payable entry and the seller has to put those defective goods back on their balance sheet.
Which likely triggers an immediate impairment write-down because they are damaged goods, right?
Exactly. You are already thinking like an auditor. And this is why auditors spend weeks just testing these shipping cutoff dates around December 31st.
Because a company could so easily manipulate their numbers, like recognizing incoming FOB destination inventory too early to inflate assets.
Or taking outgoing FOB destination inventory off the books too early to prematurely recognize the revenue.
Cutoff testing must be one of the most rigorous phases of the audit for exactly that reason.
It absolutely is. But once we confirm the goods are legally in the company's control, we move to the next battlefield. We have to figure out exactly how much they cost to build.
And this is where the cost-stuffing trap gets deployed.
Oh, yes, it does.
Right, because if I'm a slick CFO trying to inflate my balance sheet, I want to pack as many costs into the value of that inventory as legally possible.
It's the natural incentive. Under IAS 2, the initial measurement of inventory allows for 3 distinct cost buckets: costs of purchase, costs of conversion, and other costs.
Let's dig into bucket 1, costs of purchase.
On the surface, this seems pretty straightforward. It includes the gross purchase price you paid the supplier. You also add import duties, non-recoverable taxes, and the direct transport and handling costs required to get the raw materials to your factory doors.
So basically, any unavoidable cost incurred just to get the physical item into your possession.
Exactly.
But you've warned me, there is a massive auditor red flag hiding in the purchase costs regarding discounts.
Yes. IAS 2 strictly requires that you must deduct all trade discounts, volume rebates, and similar subsidies from the cost of purchase.
Okay, let me challenge that because I can totally see how a company might try to game this. Say I'm a massive global retailer, right?
Okay.
I sign a contract with a supplier to buy 1 million units of a product throughout the year at $10 a unit. But the contract has this secret side clause. If I actually hit that 1 million unit volume target by December 31st, the supplier will wire me a massive $1 million retrospective volume rebate.
Very common setup.
So can I just leave the inventory sitting on my balance sheet at the initial $10 sticker price and record that $1 million wire transfer as a totally separate windfall gain on my income statement?
If you try that, your auditor will issue a massive adjustment.
Yeah.
You absolutely cannot record it as a separate gain while leaving the inventory at the gross price. Let's trace the economic logic of why.
Okay, track it for me.
If you leave the inventory on the balance sheet at $10 a unit, you are lying about the asset's true value. You didn't actually pay $10 because that retrospective rebate means your net cost was effectively $9 a unit.
Ah, I see the trap. If I leave it at the artificially high $10 sticker price, my balance sheet assets look bloated.
And worse, think about what happens next year. When you eventually sell those units, your cost of goods sold will be recorded at $10, which makes your future profit margins look terrible.
So the rebate has to be backed out of the inventory cost, so the balance sheet reflects the true net economic reality of the transaction.
Precisely. The auditor has to actively hunt for those retrospective volume rebates. They will pull the supplier contracts, look for side letters, and force management to retroactively allocate that rebate back to reduce the carrying amount of any of those million units that are still sitting unsold in the warehouse.
Man, they have to dig deep. Okay, that secures the first bucket. But bucket 2 is where the dark arts of cost accounting really come out to play, isn't it?
Costs of conversion.
Yeah.
This is the process of turning raw materials into finished goods.
Right. Now, direct labor is easy. You pay a worker $20 an hour to assemble a chair. You just add $20 to the cost of the chair. But then we get to the allocation of overhead.
And overhead allocation is where the fraud happens.
Really?
Well, variable production overheads, like the electricity required to run the assembly line, those fluctuate directly with production volume, so they are relatively straightforward to allocate based on actual use of the facilities.
Okay, so electricity is fine. What's the danger zone?
The extreme danger zone is fixed production overheads.
Fixed overheads. So these are the massive costs that stay exactly the same regardless of whether you produce one single unit or 1 million units.
Exactly. Think about the depreciation on a multi-million-dollar factory building, or the factory manager's annual salary, the property taxes.
So how do you allocate a fixed cost without manipulating things?
To prevent management from hiding inefficiencies in these fixed costs, IAS 2 enforces an incredibly strict rule. It's called the normal capacity rule.
Normal capacity, what does that mean in practice?
It means fixed overheads must be allocated to the cost of inventory based on the normal production capacity of the facilities, not the actual production for that specific year.
Oh, wow. I need to map this out with numbers because this is where I can see a manager under pressure doing some serious damage to the financial statements.
Let's set up a scenario.
Okay, let's imagine a manufacturing facility that incurs $100,000 in fixed overhead for the year, just building, depreciation, and property taxes.
Okay, 100,000 fixed. And let's say management, looking at historical averages and maintenance schedules, determines that under normal operating conditions, this factory produces 50,000 units a year.
So the math is simple so far. You take the $100,000 in fixed costs, divide it by the normal capacity of 50,000 units. That gives us a standard allocation rate of $2 per unit.
Right. Every time a widget comes off the assembly line, we capitalize $2 of overhead into its inventory value on the balance sheet.
Okay, now let's introduce a crisis.
Always a crisis.
Let's say there is a brutal labor strike midway through the year. Or maybe a massive supply chain failure that starves the factory of parts. The factory just sits idle for weeks. By December 31st, they haven't produced 50,000 units. They've only managed to produce 40,000 units.
Okay, so actual production is lower than normal capacity.
Right. So put me in the shoes of a desperate factory manager whose annual bonus is tied to gross profit margins. I'm staring at that $100,000 in fixed overhead. It's a sunk cost. The money is gone.
Yep. The rent is still due.
If I use the standard $2 rate for the 40,000 units I actually made, I only capitalize $80,000 into inventory. That leaves $20,000 of overhead completely unaccounted for.
Which would normally hit your income statement.
Right. So why don't I just take the full $100,000, divide it by the 40,000 units I actually made, and come up with a new rate of $2.50 per unit. I capitalize $2.50 into every widget. My ending inventory looks much more valuable, and I successfully hide that $100,000 cost on the balance sheet.
And in doing so, you have directly violated the core principles of IAS 2.
Busted.
An auditor will spot that inflated allocation rate immediately and reverse it. Let's look at the underlying mechanism driving the standard's logic here. The fact that your factory suffered a labor strike does not make the 40,000 goods you actually managed to produce inherently more valuable.
Oh, that makes total sense. The consumer at the end of the line doesn't care about my factory drama. They aren't going to pay a premium for a widget just because my workforce went on strike.
Sticking a higher cost on the balance sheet violates the prudence concept. The auditor will force you to revert to the normal capacity rate of $2 per unit.
So because I produce 40,000 units, I am legally capped at capitalizing $80,000 of fixed overhead into the inventory value.
Exactly.
But wait, the rent and depreciation still cost $100,000. Where does that remaining $20,000 go?
That $20,000 is classified as unallocated waste. It represents the explicit financial cost of your idle capacity during the strike. Under IAS 2, that unallocated overhead must be expensed immediately to the profit or loss statement in the current period.
Oh, wow. That is a brilliant piece of regulatory design.
It is, isn't it?
It forces the company to take the financial hit for their inefficiency or misfortune right now out in the open rather than burying it deep within the inventory valuation to just be discovered by investors next year.
Exactly. Spreading fixed overhead costs over a critically low number of actual production units is a massive warning sign that a company is trying to inflate their ending inventory during an economic downturn.
Okay, but let's take that logic one step further and look at the reverse scenario. What if it is an exceptionally good year?
Okay, high production.
Yeah, what if the factory runs at maximum overdrive and produces 60,000 units? Do we still use the $2 normal capacity rate?
Think about the math on that.
Wait, if we use the $2 rate on 60,000 units, we would capitalize $120,000 of fixed overhead. But the actual fixed overhead was only $100,000. We would be inventing $20,000 of value out of thin air.
Precisely why IAS 2 has a safeguard for abnormally high production.
Yeah.
In this case, you were forced to decrease the allocation rate.
So I have to recalculate it.
Yes. You must divide the actual $100,000 by the actual 60,000 units, resulting in a lower rate of roughly $1.66 per unit.
So the standard ensures that inventories are never measured above their actual historical cost, no matter how efficient the factory was.
It's a completely airtight system.
Okay, so what about the third bucket, other costs?
Other costs are heavily restricted. You can only capitalize them if they were specifically incurred in bringing the inventory to its present location and condition.
Like what?
A common example is non-production design costs. Let's say you are manufacturing a highly customized, bespoke piece of industrial machinery for a specific client.
All right.
And you had to hire a specialized external engineer just to design the schematics for that one single unit. Those specific product design costs can be capitalized into the value of that specific machine.
Because it's directly tied to bringing that exact item into its present condition.
Exactly.
So we've mapped out what goes in. Let's define the strict cost exclusions. What costs does an auditor automatically rip out of an inventory valuation?
Well, the standard explicitly lists several exclusions. We already discussed abnormal amounts of wasted material or labor, like the factory strike example.
Right, idle capacity waste.
You must also exclude all administrative overheads that do not directly contribute to bringing inventories to their present location and condition.
So like the CEO's massive salary at corporate headquarters.
Right.
Or the HR department's budget.
None of that touches inventory. It goes straight to the income statement as a period expense.
Makes sense.
Selling and distribution costs are also strictly excluded. The commission you pay a salesperson to move the product has absolutely nothing to do with the cost of building it.
Right. But what about storage costs? Because this feels like a massive gray area where companies could really try to hide expenses.
It often is.
If I have a gigantic warehouse full of finished electronics just waiting for a buyer, can I capitalize the monthly rent for that warehouse into the value of the electronics? I mean, the boxes physically have to sit somewhere.
This is a frequent error that auditors have to flag. The answer is generally no. You cannot capitalize idle facility waste or warehouse rent for finished goods that are just sitting there waiting for buyers.
So they just hit the income statement.
Yes. Once the production process is complete and the item is in its intended condition, any further storage costs are immediately expensed to the income statement.
Okay, let me throw a wrench in that. What if storage isn't just waiting, but is actively part of the production process?
Give me an example.
Like a distillery making a high-end whiskey. It goes into an oak barrel and physically has to sit in a climate-controlled warehouse for, say, 12 years before it actually becomes a finished good. Can they capitalize 12 years of warehouse rent?
That is the crucial distinction. In the whiskey example, the storage is a necessary intermediary stage in the actual production chain.
Because the chemical aging process is doing the work.
Exactly. It's actively bringing the inventory to its intended condition. Therefore, the storage costs, the warehouse rent, the climate control, can be capitalized into the WIP inventory value of those barrels.
But once it's bottled,
the moment that whiskey is bottled, boxed, and sitting on a loading dock waiting for a distributor, the capitalization strictly stops.
Okay, let's take a breath and survey the landscape here. We've successfully built the asset on the balance sheet. We've followed the complex FOB rules. We backed out the secret supplier rebates. We used normal capacity for overhead. And we excluded all the abnormal waste and corporate admin costs.
It's a lot of steps.
It is. And now we have a rock-solid inventory value based on historical cost. But the lead auditor knows the world outside the warehouse changes rapidly.
It rarely stays still.
What happens when the inventory sitting in the warehouse is suddenly worth significantly less than what it cost to make it?
This transition moves us from initial measurement into the reality check of subsequent measurement, because IAS 2 doesn't let you build the asset and just blindly carry it forward forever.
You have to reevaluate it.
You are required to constantly reevaluate it against the brutal reality of the current market.
At minimum, I assume this evaluation happens at every single reporting date.
Yes. The auditor forces management to run a test. Is the historical cost currently sitting on the balance sheet greater than the net realizable value?
And if it is,
an impairment is triggered.
Okay, let's dissect this term, net realizable value, or NRV, because the glossary definition is very specific.
It is. It is the entity-specific net amount that a company expects to realize from the sale of inventory in the ordinary course of business.
Let's pause on entity-specific, because this seems unnecessarily complex to me. We have an entire accounting standard, IFRS 13, dedicated to measuring fair value.
We do?
And fair value is basically just looking at what the broader open market says something is worth. Why did the accounting board create this highly specific internal NRV calculation for inventory rather than just forcing companies to look up the market price?
It's a fundamental question, and it goes right to the heart of the IASB's basis for conclusions. When drafting the standard, the board heavily debated whether inventory should just be measured at fair value.
Why did they reject it?
They ultimately rejected it because the recovery of inventory value is inherently non-financial. It's highly dependent on the operational realities of the specific business holding it.
Meaning, the board didn't care what some theoretical generic market participant would pay for a pallet of unfinished widgets. They wanted to measure what the specific company actually expects to pocket.
Precisely. Think about it. Let's say your company has a locked-in, ironclad, long-term distribution agreement with a massive retailer that guarantees you a specific selling price for your goods.
Okay.
Meanwhile, your direct competitor is currently struggling to find buyers in a saturated open market. Or perhaps your company has a highly efficient internal sales team that only costs 2% in commission, while the market average is 10%.
I see. Fair value is a broad, generalized price that just ignores all of those internal efficiencies in specific contracts.
Exactly. NRV forces management to look in the mirror and assess their own specific reality.
Okay, so it's about what they actually expect to pocket after all their specific hurdles. Let's make this concrete. Walk me through an NRV calculation where, say, a junior auditor might fail the test, but a lead auditor catches the manipulation, the damaged smartphone scenario.
I love this example. Imagine you are auditing an electronics wholesaler. They are holding 1,000 brand new smartphones in stock.
Okay.
Between the purchase price, transport, and capitalized overhead, these phones cost exactly $300 each to acquire. So the historical cost sitting on the balance sheet is $300,000.
Clear enough, $300 a phone.
But disaster strikes. There is a minor roof leak in the warehouse.
Oh, no.
The internal phones themselves are fine, but the retail packaging on all 1,000 phones got severely water damaged. Furthermore, a competitor just released a newer model, so the market for this specific phone has cooled down.
Not a good week for the wholesaler.
No. So management does some market research and estimates they can now only sell these phones for $250 each.
Okay, if I'm a junior auditor, I look at that and do the simple math. Historical cost is $300. Estimated selling price is $250. We need to write the inventory down by $50 a phone to match the new selling price.
And if you stop there, you have fundamentally misunderstood NRV, and the balance sheet is still overstated.
Wait, why? I used the lower estimated selling price.
Because the estimated selling price is just the starting point of the NRV formula.
There's more to subtract.
The full calculation is estimated selling price less the estimated costs of completion, less the estimating costs necessary to make the sale.
Oh, I see.
To actually achieve that $250 selling price, the wholesaler cannot hand a customer a waterlogged, moldy cardboard box. They have to fix the packaging.
Ah, they have to incur rework costs.
Exactly. Let's say management estimates it will cost $40 per phone to source new boxes, repackage the devices, and print new barcodes.
Okay, minus 40.
Furthermore, because this is now considered damaged stock, they had to incentivize their sales team with a special bonus commission just to get rid of it. Let's estimate that commission at $10 per phone.
Let me rerun the math with those entity-specific hurdles. So, estimated selling price is $250, but we have to subtract the $40 rework cost. Right. And subtract the $10 sales commission, which means the true net realizable value, the actual cash the company expects to pocket at the end of the day, is only $200 per phone.
That is the true NRV. Now, execute the prudence concept test. Compare the historical cost to the NRV.
The cost was $300. The NRV is $200. That's a massive $100 hit per phone. For the 1,000 phones in the warehouse, that is an immediate $100,000 write-down.
And the mechanical impact of that is severe.
Yeah.
That $100,000 is immediately recognized as an expense on the current period's income statement.
Just cratering the company's profit.
Yep. Simultaneously, the asset value of that inventory on the balance sheet drops from $300,000 down to $200,000.
It's a brutal reality check for management, but it absolutely protects the investor.
That's the goal.
An investor reading that balance sheet won't be fooled into thinking the company holds $300,000 worth of liquid assets when the economic reality is significantly bleaker. Now, what if the story takes a bizarre turn?
I'm intrigued.
What if 6 months later, that specific model of smartphone suddenly goes viral on social media as a retro aesthetic?
Ah, trend reversal.
Yeah, demand skyrockets, and the estimated selling price shoots up to $400. The utility of the inventory has fully recovered. Do we get to reverse that painful impairment?
Under IFRS, yes. If the economic circumstances that caused the original write-down have definitively changed and the NRV increases, you are actually required to reverse the write-down.
Fantastic. So I can write the inventory value on the balance sheet all the way up to the new $400 NRV.
Absolutely not.
Why not?
The reversal is strictly legally capped at the amount of the original write-down. You can never value the inventory higher than its original historical cost cap.
The prudence concept strikes again. Good news has to wait.
Exactly. The original cost was $300. You wrote it down to $200. If the new NRV shoots up to $400, you are only allowed to reverse the $100 write-down, bringing the carrying amount back up to the $300 original cost.
So the remaining $100 of potential profit cannot be recognized until you actually sell the phone to a customer.
That's correct.
We've tracked the intense math of building the inventory, allocating the overhead, and enforcing the NRV reality check. Now, for the accounting students and professionals listening, let's translate this narrative into the actual mechanics of the general ledger.
The journal entries.
We need to map out the journal entries that tell the story of the inventory's life cycle. Looking at abstract rules is one thing, but seeing the flow of debits and credits through an ERP system like SAP or Oracle is how you actually see the financial blood pumping through the company.
It is a closed-loop financial cycle, and there are 5 critical journal entries that an auditor will trace through the system. Let's follow the economic value as it moves.
Step 1. The initial purchase. A truck full of raw materials arrives at the factory.
In the ERP system, you debit your inventory raw materials asset account. This increases the value of your assets on the balance sheet. Crucially, as we discussed, this entry must be booked net of any trade discounts or expected volume rebates.
Got it. And to balance.
To balance the ledger, you credit cash, or more likely, accounts payable if you bought it on, say, 30-day credit terms.
Okay, so the raw materials are sitting on the balance sheet. Step 2, capitalization. We start running the machines and building the products.
As the materials physically move onto the factory floor, the accounting system moves the value. You debit inventory work in progress, or WIP, building up a new asset account.
And what are the credits?
To balance this, you execute multiple credits depending on the costs incurred. You credit the raw materials account to move that value into WIP. You credit payroll for the direct labor of the assembly workers. And crucially, you credit factory depreciation or overhead allocated to capture that standard normal capacity rate we calculated earlier.
I just love visualizing this. You are literally sucking value out of the payroll and depreciation expense accounts and trapping it inside the WIP asset on the balance sheet.
It's exactly like that.
Step 3, the reality check. We run the year-end test and discover that cost is greater than NRV. Like the smartphones that got damaged, we have an impairment.
The system requires a painful entry here. You debit the profit or loss statement specifically, and inventory write-down expense account, or directly into cost of sales. This immediately reduces your reported profit for the year.
Ouch.
Yeah. To balance it, you credit inventory, or more commonly, a contra asset account called allowance for inventory obsolescence, which drags down the net asset value on the balance sheet.
The hit is taken. Step 4, the reversal. The viral social media trend happens, the market recovers, and we can reverse the previous write-down.
It is the exact mechanical opposite of step 3. You debit the allowance for inventory obsolescence to increase the net asset value back up to the original cost cap, and you credit the profit or loss statement, effectively reducing your expenses for that period and boosting profit.
And finally, step 5, derecognition. The glorious day the finished goods are loaded onto a truck and actually sold to a paying customer. This requires a simultaneous 2-part entry to capture the whole picture, right?
Yes, because 2 distinct economic events are happening at the exact same moment. First, you recognize the external transaction, you debit cash or accounts receivable, and you credit sales revenue.
That's the first part.
Second, you must derecognize the internal asset. You debit cost of goods sold, finally creating that massive expense on the income statement, and you credit inventory, finished goods, permanently removing the physical asset from the balance sheet.
I just want to pause and appreciate the beauty of the matching principle embedded in those entries.
It is elegant.
That inventory asset sits quietly on the balance sheet for months, absorbing purchase costs, soaking up labor, capitalizing overhead. It just waits. It doesn't touch the income statement's profit line, except for those painful impairment checks, until the exact same period that the revenue from its sale is recognized.
The expense of the CUGS is perfectly matched against the revenue it generated,
providing a true picture of the profit margin for that specific transaction.
That matching principle is the entire theoretical foundation of accrual accounting. It prevents companies from front-loading expenses in one year and revenues in another.
So the journal entries show us how the system is designed to work in a perfect world. But a lead auditor knows that companies don't just game the system by manipulating overhead allocations or ignoring NRV hurdles.
No, they get much more creative.
They manipulate the very assumptions about which specific costs are assigned to which specific unit sold. This introduces us to the complex world of cost formulas and the infamous LIFO ban.
Right. And the problem here arises from sheer scale.
How so?
Well, if a company sells 2 custom-built luxury yachts a year, they know exactly what each specific yacht costs to build. But if a company sells 2 million identical microchips a year, and they bought batches of those microchips at wildly fluctuating prices throughout the year,
It is physically impossible to track exactly which physical microchip went to which customer.
Exactly. Therefore, IAS 2 allows companies to use cost formulas to make standardized assumptions about the flow of costs.
So if I can't track the exact item, what are the permitted formulas under IFRS?
As mentioned, if you sell unique, non-interchangeable items like custom jewelry or specialized real estate, you must use specific identification. You track the exact cost of that specific item.
Sure.
But for vast quantities of interchangeable items, you have 2 choices. The first is first in, first out, universally known as FIFO.
FIFO assumes a logical flow. The oldest units you bought or manufactured are assumed to be the first ones you sell to a customer.
Exactly. The alternative is weighted average cost. Under this formula, the cost of each item is determined from the weighted average of the cost of similar items at the beginning of a period and the cost of similar items purchased or produced during the period.
Weighted average just throws all the historical costs into a giant blender and averages them out across the total number of units available.
But that's a great way to picture it.
But we have to address the massive elephant in the room here. There is a third formula that is famous in the accounting world, but is strictly, unequivocally prohibited by the IASB.
Ah, yes. Last in, first out, LIFO.
LIFO is banned under IFRS. I really want to understand the IASB's core logic here. Let me try an analogy to see if I grasp how bizarre this formula actually is.
Go for it.
Is LIFO basically like walking into a grocery store, reaching all the way into the very back of the dairy fridge to buy the newest, freshest carton of milk, while the store manager deliberately leaves the oldest milk sitting at the front of the fridge to just rot and curdle for decades?
That is a visceral but incredibly accurate analogy for how LIFO treats financial costs. Under LIFO, the assumption is that the newest, most recently purchased items, the last in, are the first ones sold and expensed to cognizate the first out.
Which makes zero sense in physical reality. No sane business operates like that unless they are literally piling coal in a corner of a yard and a bulldozer is just scraping inventory off the top of the newest pile.
Precisely. The IASB banned LIFO primarily because it creates an entirely artificial accounting flow that rarely, if ever, reflects the physical reality of how goods actually move through a supply chain.
But the board's concern wasn't just about theoretical neatness, right?
No, the financial reporting risks of allowing LIFO are severe, particularly during periods of high inflation.
Let's unpack the inflation angle. What exactly happens to the balance sheet and the income statement during an inflationary period under LIFO?
During inflation, the cost to acquire inventory is constantly rising. Under LIFO, you are taking those newest, highest costs and expensing them immediately against your current revenue in the cost of goods sold equation.
This maximizes your COGS expense.
Which minimizes your reported current profit. And in many tax jurisdictions, lower profit means a significantly lower tax bill. That's the primary reason companies lobby so hard to keep it.
Okay, so the income statement absorbs the new expensive costs. But what is left sitting on the balance sheet as the ending inventory?
The oldest costs. The milk from 1985, the first in layers.
Oh.
Under LIFO, those oldest, cheapest layers of inventory remain trapped on the balance sheet indefinitely, as long as inventory levels never drop. If you have an industrial manufacturer that has been using LIFO for 40 years, they might have massive stockpiles of inventory sitting on their balance sheet valued at 1980s prices.
Which renders the balance sheet practically useless to an investor or a creditor trying to understand the current real-world value of the company's liquid assets. It massively understates the true value.
The understated balance sheet is bad enough, but it introduces an even more dangerous fraud risk, a scenario known as a LIFO liquidation.
LIFO liquidation. That sounds like a retailer throwing a desperate going out of business sale, but I'm guessing in this context, it's a highly orchestrated accounting trick.
It is a devastatingly effective earnings management trick. Let's build a scenario.
Okay.
Imagine a CEO is having a terrible year. Sales volume is stagnant. Current profit margins are squeezed by inflation. They are going to miss Wall Street earnings expectations, and the executive bonuses are at severe risk.
A desperate CEO.
But this CEO has a secret weapon. 40 years of ultra-low-cost LIFO inventory layers buried deep on the balance sheet. As year-end approaches, they order the purchasing department to completely stop buying new raw materials.
Okay, so they just stop buying.
They keep production running by just consuming their existing stock, drawing the physical inventory levels down lower than they have been in decades.
Let me trace the math on that. Because they aren't buying new, expensive inventory to act as the last-in layer, the LIFO formula is forced to dig deeper and deeper into the historical layers to calculate the KGS for the goods they are currently selling.
Exactly. The formula dips into the 2010 layers, then the 2000 layers, and finally hits those ultra-cheap 1980s layers.
Oh, wow. So suddenly, on the income statement, they are matching 2026 sales revenue against 1985 acquisition costs.
And the result is explosive. CODICEP plummets to artificially low levels. Gross profit artificially spikes. The CEO hasn't fundamentally improved the business operations. They haven't sold more volume. They haven't increased market share.
They just deliberately liquidated old accounting layers to manufacture a massive one-time surge in paper profit.
That's it.
That is wild. They basically harvest 4 decades of hidden, unrealized inflation gains in a single quarter just to save their bonuses and fool the market. No wonder the IASB outright banned it. It completely destroys year-over-year comparability.
And provides a built-in lever for blatant earnings management. Eliminating LIFO was a cornerstone of the IASB's improvements project to increase transparency.
However, I'm guessing its continued existence elsewhere causes problems.
It leads to a massive, very common error that auditors must watch out for during complex group audits.
What's the error? If it's banned under IFRS, it's banned, but you just don't use it.
It is banned under IFRS, but it is still permitted and highly utilized under US GAAP, largely because the U.S. Internal Revenue Code allows it for tax purposes, provided there is strict conformity between the tax return and the financial reporting.
Ah, I sense the cross-border consolidation complications arising.
Exactly. You will frequently see a corporate structure where a massive European parent company, reporting under IFRS, owns a manufacturing subsidiary operating in the United States.
Okay.
That U.S. subsidiary uses US GAAP and LIFO for its local statutory and tax reporting to save money. But at year-end, when that U.S. subsidiary's financials are rolled up and consolidated into the European parent's global IFRS financial statement.
Let me guess. The parent company's accounting team tries to take a shortcut. They just try to sneak the LIFO numbers directly into the group consolidation to save the immense headache of recalculating a whole year of inventory flows.
Yes. And a competent group auditor has to catch that instantly. They must force the company to unwind the entire LIFO calculation, reconstruct the subsidiary's inventory ledgers, and post massive topside adjustments to convert those numbers to FIFO or weighted average before the final group consolidation can be signed off.
It sounds incredibly tedious.
It is incredibly tedious work.
Okay, so we've spent a massive amount of time deep inside the machine looking at how the initial costs are built, how overhead is allocated, how NRV write-downs are calculated, and how the formulas flow. Now let's zoom out.
To the external view.
Yeah. How does this all look to the outside world, to the investors, the analysts, and the creditors who are actually reading the final published annual report?
The final output of all this rigorous auditing and calculation lives in the required disclosure section of the financial statements. IAS 2 isn't just concerned with getting the single final number right on the face of the balance sheet. It demands that companies tell the investor exactly the narrative of how they arrived at that number.
Let's run through the mandatory disclosures. What specifically must companies reveal to the public?
Several key elements. First, they must disclose the specific accounting policies adopted for measuring inventories, prominently including the cost formula used. Investors need to know upfront, are we looking at a FIFO company or a weighted average company?
Right.
Second, they must disclose the total carrying amount of inventories. And crucially, they must break that total down into classifications appropriate to the entity, typically raw materials, WIP, and finished goods.
Let's dig into why an investor actually cares about that breakdown. On the surface, $1 of inventory is $1 of inventory. Why does an equity analyst care if it's flour or baked bread?
The composition of those buckets tells a vivid story about the hidden health of the supply chain and future sales pipelines.
Give me an example.
Let's say an analyst is tracking a major hardware manufacturer. They read the footnotes and see a sudden massive spike in the raw materials bucket, coupled with a simultaneous steep drop in finished goods. What is the operational reality behind those numbers?
Well, it tells me they are aggressively hoarding parts, maybe anticipating a shortage or a tariff, but they're completely failing to actually assemble the product.
Exactly.
It signals a severe structural production blockage. Maybe a key factory went offline, or they are missing one tiny critical microchip that prevents them from finishing the build.
A smart analyst might see that raw materials spike, realize the company won't have anything to actually sell next quarter, and immediately short the stock before the catastrophic earnings call even happens.
Wow. Now, conversely, what if finished goods are skyrocketing, but raw materials and WIP are dropping to zero?
What does that look like to you?
That looks like they are churning out millions of products that absolutely nobody is buying. The warehouse is filling up, and they've slammed the brakes on new production to stop the bleeding.
Precisely. That company is about to face a massive obsolescence problem and a brutal NRV write-down next quarter.
The breakdown reveals the future. What else must they disclose?
They must report the total amount of inventory recognized as an expense during the period, the IAS. They must explicitly disclose the exact amount of any inventory write-downs recognized in the profit or loss statement and the amount of any reversals of previous write-downs.
And the reversal.
If they do record a reversal, they must describe the specific economic circumstances that drove that recovery. Finally, they must disclose the carrying amount of any inventories pledged as security for liabilities.
That write-down disclosure is huge. Massive recurring hidden write-downs reveal a company that has completely lost its product pricing power.
Oh, absolutely.
If you are analyzing a fast fashion retailer or a consumer electronics company, and the footnotes reveal they are quietly writing down 20% of their inventory value every single year, that tells an investor their design team is failing.
Or their demand forecasting is terrible.
Yeah, their products are obsolete and unwanted before they even hit the store shelves.
If you look at how real-world behemoths apply this, it becomes very tangible. Pull the annual report of a global supply chain manager like Apple or a retail powerhouse like Adidas, and you will see the principles of IAS 2 aggressively at work in their footnotes.
Beyond just stating, we use FIFO and lower of cost or NRV, what specific insights are we looking for in their disclosures?
You're looking for their disclosures regarding management judgments and estimates. As we've discussed, applying IAS 2 requires significant, highly subjective estimates.
Like predicting factory uptime for normal capacity.
Exactly. Projecting future NRV requires predicting consumer behavior. And determining the specific provision for obsolescence is perhaps the biggest judgment call of all.
Because they can't evaluate every single t-shirt or microchip individually, they have to use broad statistical models.
Yes. You will often see companies outline the mathematical formulas driving their judgments. For instance, a fast fashion retailer might disclose in their footnotes that they use an automated aging matrix.
How does that work?
Any clothing item that remains unsold after 90 days is automatically written down by 30%, and anything older than 180 days is written down by 70%, regardless of whether local managers still think they might eventually sell it.
They enforce a brutal mathematical discipline based on their historical trend analysis. If a fashion item hasn't moved in 6 months, the data says it's virtually dead stock, and they take the financial hit immediately. Setting those exact percentage parameters requires immense industry experience.
It is the dividing line between theoretical accounting and applied business acumen. Knowing the strict rule of lower of cost and NRV is easy. Knowing how to accurately estimate the future demand curve of a specific semiconductor in a volatile global market is incredibly difficult.
We touched on this briefly with the LIFO discussion, but before we wrap up the technical deep dive, let's do a more comprehensive cross-border auditor briefing. Comparing IS2 under IFRS against US GAAP, specifically ASC 330. We know LIFO is prohibited internationally, but heavily used in the US for tax conformity. Where else do these massive frameworks diverge on inventory?
The treatment of impairment reversals is a major philosophical divergence. We just discussed how IFRS requires a reversal if economic conditions improve, capped at the original cost. If the damaged smartphone becomes a retro hit, you write the value back up.
Right. The balance sheet tracks the recovery of utility. How does US GAAP handle that?
Under US GAAP, impairment reversals are strictly categorically forbidden.
Really? Why the absolute ban?
US GAAP takes a significantly more conservative view regarding asset valuation. Under US rules, once you write down an inventory item, that newly reduced amount becomes its new immutable cost floor.
Even if the market price of that inventory triples the very next day.
Even then, you cannot write the asset back up. It stays at the impaired value until you finally sell it or scrap it.
Wow. So IFRS wants the balance sheet to dynamically reflect the most current expected recovery value up to the historical cap, while US GAAP prioritizes absolute conservatism. They'd rather understate the balance sheet than open the door to earnings manipulation through volatile, subjective write-ups and write-downs.
Exactly. And there is a profound nuance in the subsequent measurement framework itself. IFRS applies the strict lower of cost and NRV test universally to all inventory. US GAAP applies lower of cost and NRV to companies using FIFO or weighted average. But if a US company utilizes LIFO, they're subjected to an entirely different legacy test called lower of cost or market value.
Market value instead of NRV, what's the difference?
In the US GAAP LIFO context, market generally refers to the current replacement cost of the inventory, not the estimated selling price. But it is constrained by complex ceiling and floor limits. The market value cannot exceed the NRV, that's the ceiling. And it cannot be lower than the NRV minus a normal profit margin. That's the floor.
That sounds like an absolute nightmare for a dual-listed multinational company trying to reconcile their books. Testing different inventory pools, using different formulas, different recovery tests, and tracking irreversible impairments.
It is a massive, highly technical reconciliation headache that requires specialized software and keeps thousands of cross-border accountants fully employed.
So we've covered an immense amount of ground today, from the freezing warehouse to the depths of the ERP system. Let's summarize the toolkit we've built. If you are an accounting student or a financial analyst listening to this, and you want to adopt the mindset of a lead auditor investigating inventory, what are your new superpowers?
Your primary superpowers are professional skepticism and a deep mechanical understanding of how the numbers flow. You don't just look at the final balance sheet number, you interrogate the inputs. You know to hunt for improper overhead capitalization. You scrutinize the normal capacity math to ensure management isn't bearing the financial costs of a factory strike or a supply chain failure in the asset value. You actively hunt for hidden volume rebates that should be reducing the purchase costs.
And when it comes to the reality check, you ruthlessly test the net realizable value. You don't just accept management's optimistic estimated selling price. You dig into the specific entity-level hurdles. You demand estimates for rework costs, packaging, and specific sales commissions to find the true, much lower NRV. You force the pain of the prudence concept.
Because you understand the fundamental zero-sum game. You know that every single dollar improperly stuffed into the ending inventory on the balance sheet is a dollar of expense stolen from the income statement and a dollar of profit fraudulently claimed today. IAS 2 isn't just about accurately counting cardboard boxes, it's the primary defense mechanism protecting the integrity of the income statement.
Defending the integrity. I think that perfectly encapsulates the mission. Which brings me to a final, somewhat provocative thought to leave you, our listener, to mull over as you study these standards. We started this deep dive, standing in a warehouse, looking at physical boxes, realizing that the balance sheet is basically a mathematical construct. We talked at length about how IAS 2 uses historical cost as its foundational bedrock, supposedly representing a hard, factual record of what was spent. But think about the mechanics we just dismantled. To figure out the historical cost of a manufactured item, management has to estimate future normal capacity. To figure out the NRV write-down, management has to use a crystal ball to predict future consumer demand, future competitor discounts, and future obsolescence rates.
It's all based on estimates.
Exactly. If IAS 2 forces companies to base both their overhead allocations and their impairment write-downs on highly complex, highly subjective estimates of future events, to what extent is the supposedly objective historical cost of inventory actually just a prediction of the future in disguise?
It fundamentally challenges the idea that accounting is just looking in the rearview mirror.
And if management's crystal ball is wrong, if they slightly misjudge normal capacity, or if consumer trends shift overnight, rendering their NRV models useless, is that multi-million-dollar number sitting on the balance sheet already a fiction the very moment the annual report is published?
It makes you look at those mountains of cardboard boxes in the warehouse very differently, doesn't it?
It really does. You can count the physical boxes all night long, but the real truth is always hidden in the assumptions driving the math. Keep asking those questions, keep digging past the surface of the standards, and we'll see you on the next deep dive.
Thank you for listening to Reporting Matters. Before we go, please note that this discussion is for informational and educational purposes only. Nothing stated in this episode constitutes investment, legal, financial, accounting, or tax advice, nor does it replace the professional judgment of a qualified human professional. Reporting Matters endeavors to ensure the quality of its content, but AI systems can generate inaccuracies. We make no warranties regarding the completeness, timeliness, or accuracy of this information. Listeners should conduct their own independent research and consult a certified financial professional before making any financial or investment decisions.